Do you remember where you were in 2008? Maybe you were a kid, a teenager, or just starting out in your career. You might not have understood the complex terms like subprime mortgages or credit default swaps, but you felt it. You felt the tension in your parents' voices. You saw the headlines on the news, the red arrows pointing down, down, down. You saw neighbors packing up their homes, the "for sale" signs that lingered for months, replaced by "foreclosed." That wasn't just a news story. For an entire generation, the millennial generation, it was a core memory. A financial trauma that imprinted itself on our collective psyche. And today, it's quietly shaping the entire landscape of how we think about money, risk, and our future. This isn't just about investment strategies. It's about something deeper, something experts are now calling financial PTSD. Let's rewind the clock. Before 2008, the American dream seemed straightforward. Go to college, get a good job, buy a house, invest in the stock market, and retire comfortably. The market was seen as a reliable engine of growth, but then the engine sputtered, seized, and the entire vehicle went off a cliff. We watched as titans of banking crumbled. We saw our parents' retirement accounts, painstakingly built over decades, get slashed in half, sometimes even more. The promise of a secure future, built on the old rules, evaporated before our eyes. For many millennials, this was our introduction to the world of finance. It wasn't a lesson in a textbook about bull and bear markets. It was a real-life lesson in loss, instability, and broken trust. We came of age in an era of scarcity. We graduated from college with record student debt, only to enter one of the worst job markets in modern history. We were told we were lucky to get any job, even if it was unpaid. The idea of saving, let alone investing, felt like a distant fantasy. This shared experience created a deep-seated skepticism, a profound distrust of the very institutions that were supposed to be the bedrock of our financial system. While our parents and grandparents might have seen the stock market as a place of opportunity, we saw it as a casino where the house always wins. They saw financial advisors as trusted guides. We saw them with suspicion, wondering what fees they were hiding. This isn't cynicism for the sake of it. It's a defense mechanism, born from watching the people we trusted get burned. So, what does this financial PTSD look like in action today? Well, it explains a lot about millennial investment behavior that has puzzled older generations. For starters, we are famously risk-averse, far more than previous generations were at the same age. Many millennials opted to keep their money in cash or low-interest savings accounts for years, terrified of the market's volatility. The pain of potential loss felt far more real than the promise of potential gain. We'd rather earn almost nothing on our savings than risk another 2008. This cautiousness has also led to a powerful drive for financial education and transparency. We don't just take a broker's word for it. We do our own research. We flock to YouTube channels, Reddit forums like Wall Street Bets or Bogleheads, and TikTok financial influencers. We crave information, we want to understand the mechanics of what we're investing in, and we want to do it on our own terms. This isn't just about saving on fees, it's about regaining a sense of control that was lost in 2008. We want to be in the driver's seat of our own financial destiny. And that brings us to the rise of cryptocurrencies and meme stocks. To outsiders, it might look like reckless gambling. But if you understand the mindset of financial PTSD, it starts to make a strange kind of sense. When you've been taught that the traditional system is rigged, you start looking for alternatives. You start looking for a new system. For many, crypto represented exactly that. A decentralized, democratized alternative to the big banks and Wall Street firms that we felt had failed us. It was a bet, yes, but it was a bet on a different future, one outside the old rules. Similarly, the GameStop saga wasn't just about making money. It was a rebellion. It was a collective of digital natives, raised in the shadow of 2008, using their own tools, and communities to take on the hedge funds they saw as the villains of that story. It was a deeply symbolic act of defiance, a way of saying, "We remember what you did, and now we're playing the game by our own rules." It was a visceral, emotional response to a trauma that had been simmering for over a decade. But here's the crucial question. Is this mindset helping or hurting us in the long run? The caution is understandable, but hoarding cash means we lose purchasing power to inflation. We miss out on the incredible power of compound growth that is essential for building long-term wealth. The desire for control is empowering, but it can also lead us down rabbit holes of misinformation or into overly risky speculative assets that could cause another kind of financial trauma. The challenge for our generation is to find a balance. It's about acknowledging the scars of 2008 without letting them paralyze us. It's about learning the lessons of the past. Diversification, long-term thinking, understanding risk, while embracing the new tools and opportunities of the present. We can be cautious without being fearful. We can be independent without being isolated. So, how do we heal from this financial PTSD? First, by talking about it. By acknowledging that the anxiety and skepticism we feel are valid, shared experiences. It's not a personal failing. It's a generational scar. Second, by focusing on what we can control. We can control our savings rate, our budget, and our level of financial literacy. We can start small, with low-cost index funds, automating our investments so we're not constantly tempted to react to market swings. We can build a plan that acknowledges our risk tolerance but still allows for growth. The story of millennial investing is still being written. We are the generation that was shaped by a crisis, but we don't have to be defined by it. We are rewriting the rules of finance, armed with technology, community, and a healthy dose of skepticism. The ghost of 2008 will always be with us, a reminder of what can go wrong. But it can also be a powerful motivator to build something stronger, more transparent, and more resilient for ourselves and for the generations that will follow. The key is to turn the trauma into wisdom and the fear into fuel. Thanks for watching this deep dive with me today. If this story resonated with you, I'd love to hear your own experiences with money and the 2008 crisis in the comments below. Don't forget to like this video and subscribe for more content that explores the psychology behind our financial lives. See you in the next one.